Hi, welcome to another episode of 2 Minutes on Tuesday. I am Sam Miller of RE/MAX Stars Realty.
I'm Erica Miller of RE/MAX Stars Realty, and in this episode, we're going to talk about saving you money by trying to get your monthly private mortgage insurance removed from your conventional loan if you qualify.
Yeah, and private mortgage insurance for a conventional loan is where if you didn't have 20% down when you bought your property, you would get PMI or private mortgage insurance. And what that does is it insures the lender against default or foreclosure. So if they incur any losses, the private mortgage insurance would reimburse them for that loss.
And if you do have PMI insurance, you may want to check with your lender to see if you do qualify and if you can get that removed. So if you own 20% equity in your home, you can get that removed. So say you have a $200,000 house and you only owe $160,000. This would be your 20% equity that you have in it.
Some lenders will probably put you at 80%. There's a few that'll do it at 78%. But the thing I want to tell you is that the Knox County housing market, the values of homes have gone up significantly. And I'll give you some examples. So in 2019, the average sale price for a single family home in Knox County through the Knox County MLS was $184,171. In 2020, the average sale price for a single home was $200,067. And in 2021, last year, the average sale price was $219,580. So when you look at those numbers over the last 3 years, that's an increase of value just in that 3-year period of 19%, meaning the value of your property almost went up 20%, not including the minimum of 3 or 5% or 10% down you probably did when you did your conventional loan. So you're sitting on equity, and there's a very good chance you can get the private mortgage insurance removed, which could save you thousands and thousands of dollars over the course of your loan.
That's amazing that it's gone up that high in just that short amount of time. I mean, that's pretty substantial. But there are also a few other ways that you can increase equity in your home. So say you've done some home improvements, like you redid your kitchen or maybe renovated your bathroom. You could have added a concrete or asphalt driveway. Any of these types of things can increase the worth of your property. So this in turn can increase your equity.
Yeah, and if your value is boosted and they would have an appraisal done on your home and those improvements add value, you've created even more equity and a better ability to remove that private mortgage insurance. So some lenders do have a requirement that you keep the private mortgage insurance on the property for, say, 2 years or 3 years. Each loan company, each bank, the guidelines are slightly different, but you can always get it removed at 78% loan to value if you're in good standings with your lender and you actually qualify. Now, the big benefit to this is you don't have to do a refinance and pay all these closing costs all over. The loan terms that you have stay in place, so you're just basically getting the PMI removed. And a couple things to know: some lenders would require you to pay an appraisal to verify the value of the property. If you've made substantial improvements to the property, like Erica said, that will help make this a much smoother process. If you do meet the criteria and the value of the house is high enough, usually within 30 days or less, you can have that PMI removed from the loan. And once it's gone, it's gone. It doesn't come back. Now, I wanted to show you something. I ran some quick payments. I did a 95% loan. And so what I did, I ran a report. And if you made your normal payment every month and there was no additional equity for the house value going up, it would take you 7.8 years to go from 95% to 80%. And I think that's significant. So that's 94 payments, and then you would reach your 20% mark. Now, on the same loan value, if you wanted to go 78%, you're looking at 8.6 years of payments or 104 payments. The sweet spot of where we're at right now is that the housing market, the values have gone up. So even though you've been making your payment and your principal balance has been going down, at the same time, the housing market has gone up. And because it's gone up, the value of your home's gone up, you've created equity going both ways. One, by making your payment every month, which drives your principal balance down, but also the actual value of your house going up because real estate is more valuable. So anyway, our recommendation is reach out to your lender, see if this is something that you could benefit from. I mean, if you're paying $150 a month in PMI, that's a $1,800 a year savings by doing nothing more than picking up the phone. I mean, they may require you to have an appraisal done, and that may be $500 or $600, but you'd get that money back in no time, and then you're ahead of the game in 4 or 5 months. So I'm Sam Miller. Thanks for watching.
I'm Erica Miller. Yeah, and we will be back with you next week on a new video topic.
Thanks, and have a good one.
Thanks. Bye-bye.